Welcome to an introduction to the federal funds rate. The federal funds rate is an interest rate, and it's one of the most important interest rates in the banking system. And before we get into the reason for that importance, it's important to define what it is. So the federal funds rate is an interest rate that banks charge each other when they make overnight loans to each other. So banks borrow from each other. They trade reserves with each other. If a bank has some surplus reserves on hand, it may loan it to another bank overnight so that bank can make some loans that it wants to make. So banks actually cooperate with each other and loan to each other. And usually these loans are overnight loans. Sometimes they'll go as long as a day or two, but they're generally repaid within 24 hours. So they're very short-term loans, but they're very important in the banking system because banks actually like to rely on each other if they have short-term borrowing needs. It's interesting, though, that the federal funds rate then becomes a foundational interest rate for other rates. Okay, so for instance, if you look, if we go, let me show you. Let's look here at the notes. Again, a commercial break. I would strongly encourage you to take notes. This is a video, so you can stop it at any time and write something down. But it's very important that you take these ideas off my sheet here, and you write it down on your own paper, and then in the process of doing that, internalize these ideas. So again, the federal funds rate is an interest rate. It's usually an overnight loan, but it's the interest rate charged on these overnight loans. The federal funds rate is foundational to other interest rates. My example here is usually the federal funds rate. Whoop, my pen is going weird on me there. Let's try that again. The federal funds rate plus 3 is equal to what we call the prime rate. And if you actually get involved in business, the prime rate is a very important interest rate because the prime rate is the interest rate that banks charge their best business customers. So if a business goes to a bank and wants to borrow money, say to do an expansion, and that business has a very strong credit history, it's a very sound company, that business may be able to borrow at the prime rate. It's the best interest rate banks give business customers. But if that business is riskier and not as solid, it'll have to pay something higher than the prime rate. So the prime rate becomes an interest rate that business people are very, very interested in. The prime rate plus some risk premium, I'm going to go down a little bit farther here. The prime rate plus a risk premium determines credit card interest rates. I don't know if you know that. So many credit card interest rates are actually built off of the prime rate. So for instance, you see I put a little table down here, and let me just scroll down here so you can see it. This little table down here shows federal funds rate plus 3% equals the prime rate. The prime rate plus 4% would equal the credit card rate for the best credit card customer. Now, many people don't get the best credit card rate because they're risky. You know, credit card money is very risky in the sense that every time you swipe that credit card, you're taking out a loan, and credit card companies discover that many of these credit card loans are not repaid. And of course, the credit card company doesn't eat that. Who pays for that? Well, that's a loss or an expense that the credit card company passes on to other customers. So the idea that if you don't pay your credit card, the credit card company will eat that is mythology. That's passed on to other credit card customers as an expense. It's just like if somebody steals bananas from Myers doesn't eat that. They don't, in essence, pay for that. They pass that on to their customers in the form of an expense. That's actually called shrinkage, and that's passed on. So the prices at a grocery store are higher because people steal from these stores, and credit card rates are higher because people don't repay their credit card. All right. I'm sure this doesn't apply to anyone listening to my video. My students are always the most honest students out there, I'm sure. So if you look here, if the federal funds rate were 0, you go, well, that's impossible. No, it's not. I'll actually show you later on in a later video that the federal funds rate was actually 0 for a number of years. So if the federal funds rate is 0 and we add a 3% premium to get to the prime rate would be 3%, and we add a 4% premium to get to the best credit card rate, the best credit card rate would be 7%. So if the federal funds rate is 0, very low interest rates, then credit card rates would be low as well. If the federal fund rate is up around 5%, using the same logic, adding on the 3, adding on the 4, we're going to have the best credit card money going at about 12%. Okay? So the Fed, you're going to learn that the Fed can manipulate the federal funds rate. And if the Fed can manipulate the federal funds rate, it can ultimately affect the prime rate, and it can ultimately affect credit card money, car loans, and all sorts of other consumer interest rates out there. All right? So again, you're learning about monetary policy, and you're learning about how the Fed, you're going to learn in this lesson that the Fed can actually manipulate this federal funds rate, this interest rate that banks charge each other, and by manipulating that federal funds rate, guess what? It can manipulate other interest rates in the banking system, either making it easier for people to borrow or making it harder for them to borrow. That's the idea. So let's keep going here. And I'm going to be breaking this lesson up into several videos. I'm in this lesson really talking about prior to 2007. You go, why is 2007 such an important year? You're going to see why here as we go through this. But when I was teaching this, I've been teaching this course since 1985. Prior to 2007, what I'm about to say was always true. But after 2007, what I'm about to say changed. So I'm giving you a little bit of history here, because what I'm going to teach you about today, I'm going to be contrasting with 2007 and prior to 2007. Money in banking has changed a lot in the last 15 years or so. And it has to do with some major things that have happened in the U.S. economy. So it says here, prior to 2007, the federal funds rate was affected by what we call open market operations. So in our last couple of videos, we've taken a look at open market operations, what they are, the Fed buying and selling bonds in the government bond market, and the effect of those bond purchases on bond yields, okay? By affecting the supply of bonds in the bond market, the Fed is either able to drive up bond prices and therefore drive down bond yields, or drive down by bond prices and raise bond yields. So we've learned that open market operations affect bond yields, which is an important way that government borrows and an important way that corporations borrow. And it's interesting that these open market operations also what? They also affect the federal funds rate, or at least they used to. They used to. They don't affect it today, but they used to, and I want to show you why. So the Fed used to buy bonds, and that would increase the supply of bank reserves. And we talked about that a couple videos ago, that whenever the Fed buys bonds, it ends up injecting reserves into the banking system. And prior to 2007, that would actually decrease the federal funds rate. If there were more reserves in the banking system, there would be surplus reserves, and banks would be loaning those out to each other. And to loan those out, they would have to lower the interest rate to do that, the federal funds rate. And when the Fed would sell bonds, that is, it would try to contract the level of reserves in the banking system, the supply of reserves would decrease, and the federal funds rate would go up. So in other words, if the Fed pumped reserves into the banking system by buying bonds, there would be a lot of reserves in the banking system, and these federal funds rates would drop, okay? Because there were lots of reserves for banks to loan to each other. And so supply and demand. But when the Fed would sell bonds, that's infrequent, but when it would do that, it would pull reserves out of the banking system. And by doing that, it would make these reserves more scarce, and the federal funds rate would reflect that by going higher. So it's basic supply and demand. Moving the supply of these bank reserves would affect the federal funds rate. Okay? And if we go down a little bit farther here, I actually have a picture for you. This is what the market for federal funds looked like prior to 2007. Okay? And again, I was teaching economics way back in 1985, so the first 20 or so years I was teaching, this is just basically what we taught. It was really straightforward, and it hadn't changed for years, decades. So prior to 2007, the amount of reserves in the banking system were limited. Now this is an important term. This limited reserves is a very important term, because later I'm also going to be talking about, in a later video, I'll be talking about ample reserves. And ample reserves is a completely different situation. So how do we know the reserves are limited here? Well, first of all, the supply curve for reserves is this vertical function right here. The supply of reserves is not determined by interest rates. The supply of reserves is determined by how much, by the Fed's open market operations. How much in the way of bonds does the Fed buy? And so in 2007, the supply of reserves was at a certain level, and we'll be talking about those levels a little bit later. Actually, it was less than $1 trillion. And you go, well, that sounds like a lot, but actually compared to what are in reserves today, over 8 trillion, reserves, bank reserves have actually increased from, in 2007, from less than 1 trillion to today over 8 trillion. So the Fed's balance sheet has grown dramatically over 8 times since 2007. I mean, that's amazing. And that's basically what has changed everything. The Fed's monetary policy has been very, very expansionary. The Fed has bought tremendous amounts of government bonds and mortgage-backed securities, and by doing that, we'll learn, has moved this supply curve way to the right. Okay, but back in 2007, this supply curve intersected the demand curve at a positive federal funds rate. So let's talk about this demand curve. It's nonlinear. This is the demand for federal funds. Notice that at this interest rate here, whatever this is, that the demand curve doesn't go any higher than that. This is called the discount rate, and we'll be talking more about the discount rate in this course. But the discount rate is the interest rate the Fed charges banks when they borrow from the Fed. So if a bank gets in an emergency and it needs to borrow, it's in some sort of crisis or it's having some sort of difficulty, it can go to the Federal Reserve System. Remember, the Federal Reserve System is a banker's bank. Banks bank with the Fed. And so a bank that's struggling, having trouble, say, it's had a run on its deposits, or some of its loans have gone bad, and it's basically facing liquidation. It's basically facing bankruptcy. It may go to the Fed and ask to take out a loan, and the Fed may loan to it, may not loan to it, depending on how safe that bet is. The Fed may just require the bank to shut down if it's really truly a mess. But if it's just a short-term problem, the Fed may be willing to make a loan. That's called the discount rate. That interest rate would be called the discount rate. The discount rate always sets an upper limit on this demand curve, this sloping function here. This is the demand curve here, this nonlinear curve here. And you ask yourself, well, why does that set an upper limit? Well, let's think about this. If the federal funds rate were above the discount rate, no bank would want to borrow from another bank at that federal funds rate. They would prefer to borrow from the Fed at the discount rate. So the discount rate sets an upper limit. If the federal funds rate were to ever get higher than the discount rate, nobody would borrow in the federal funds market. Okay? So the federal funds rate can't go above the discount rate because banks wouldn't let it. Banks that needed to borrow wouldn't borrow from other banks, they would borrow from the Fed. So the discount rate, and the Fed knows this, so the discount rate really sets an upper limit. So I've put this dotted line here, across here, because the discount rate will limit how high the federal funds rate can go. Now the lower limit before 2007 was 0%. That once you get down to 0%, the demand for these funds would become infinite. Now the federal funds rate, if the supply curve is intersecting the demand curve here, it's not near zero, but zero ends up being the lowest it can go, okay? So what we see here is the vertical supply curve meeting the downward sloping demand curve at a positive federal funds rate. And this is called limited reserves. Limited reserves. Why? I'm having trouble writing today. I'm sorry. My little hand is not. So limited reserves, sorry, no whining. Limited reserves are where this vertical supply curve crosses with this downward sloping demand curve. Okay? You go, well, what else could it be? Well, what if the Fed pushed the supply curve way out here? Let me show you this. Now, I'm just going to do this really quickly because I don't want to get ahead of myself. But say that the supply curve was pushed way out here. If the supply curve were way out here, I gotta get the supply curve. Let's say this is S2. If the supply curve were way out here, if the Fed pushed this all the way out here, then the supply curve would be intersecting the demand curve. See, the demand curve is really tracking along here at 0. The supply curve would hit the demand curve way out here. This would not be limited reserves. This would be what we would call ample reserves. And this is actually what happens after 2009. The Fed pushes the supply curve in 2009 so far to the right that the federal funds rate is where? The federal funds rate is now down here where? Near 0. So prior to 2007, open market operations, if you move the supply curve just a little bit, or you could move it to the left a little bit or to the right a little bit, you could move the federal funds rate up and down. But if you've moved the supply curve so far to the right that the federal funds rate is 0, you get it way out here, you can move it and it has no impact on the federal funds rate. So open market operations stop being a tool where you can move the federal funds rate. If the federal funds rate is 0, the Fed effectively loses the ability to move it. You go, well, why would the Fed ever lower it to 0? Stay tuned. Okay, so I've gotten ahead of myself a little bit here, and I'm gonna erase some of this. You go, why would I do that? Because I don't want to talk about ample reserves yet. This is limited reserves. This is limited reserves. this is where the supply curve still meets the demand curve. And so if you move this supply curve to the right a little bit, the federal funds, so if this moves to the right just a little bit, the federal funds rate goes what? Federal funds rate goes down. You move this to the left a little bit, and the federal funds rate goes up, with the discount rate being the upper limit. So it used to be that the Fed, let me just keep going down here, it used to be that the federal fund rate could be impacted by open market operations. So the Fed used to do open market operations every day, buying and selling bonds every day, and in the process of doing that would be tweaking the federal funds rate. So pre-2007, this is how it worked. A movement in the supply curve using open market operations would move that federal funds rate up and down. And then, of course, if the Fed moved that federal funds rate up and down, guess what? It would be moving the prime rate up and down. And by moving the prime rate up and down, it'd be moving other interest rates, like the credit card interest rates, up and down. So the Fed had an ability using open market operations to finely tune that federal funds rate and move interest rates very quickly up or down. Okay? Now, after 2007, the Fed loses that ability, and we'll be talking about that in the next video. So make a note here that the discount rate sets the upper bound on the federal funds rate. And also make a note, this is not going to make a lot of sense to you yet, but when you watch the next video or read ahead in your e-workbook, at this point in time, the Fed did not pay interest on deposits. So the IOR rate is the interest rate on deposits. Not interest rate on deposits, interest rate on reserves. I misspoke. So the IOR is the interest rate on reserves. Prior to 2007, the Fed did not pay interest on reserves. So if a bank left its interest, it left its reserves as reserves, just had reserves sitting around, it was earning no interest on them. And that would encourage the bank to consider loaning those reserves out in the federal funds market. What you're going to learn, though, is after 2009, the Fed began to pay interest on reserves, and that ends up affecting the federal funds market. So that's going to be coming ahead. But just make a note here, prior to 2007, the Fed did not pay interest on reserves. Okay, I'm going to stop there. This is a good place to stop. Yeah, if you want to learn what happens after 2007, between 2007 and 2009, then 2010 to 2016, interesting period. And then what happened up to COVID, 2016 to 2019. And then what happened after COVID, you need to watch some additional video. All right, take care.